Greetings, market rebels. Welcome to this week's macro measure. It is actually Friday, the 29th of September. It's about 2:45 p.m. here on the East Coast when I'm recording this, but since we normally put these out on Sunday, we're sticking with that convention for now, and we're going to get right into things. We have a lot to cover, and I'm going to try to do it super quick because that is the demand. Demand is less and quicker, the way things are. So we're just going to keep doing what we can to try to help out. I guess if that's what works for people, that's what works for people. There was our disclaimer. Here's our trusty intellectual property rights notice. I'm going to flash this week's stream, which you'll see is much different, just really pared down. A lot of these reminders I like to keep in for newer folks aren't there. So we're just going to roll with what we've got. Going to do things pretty much more on the quick and dirty, I guess, the way that folks refer to it these days. This is last week's stream, and you can see there's a large difference there. You can also, again, pause at any time and take snapshots if you want to keep an eye on things. I may refer to this, and certainly we'll be referring to this week's stream. So on that note, let's switch our share to a different screen here. So let me stop the share. And then what we'll do is we will go to a different screen. Oops, we want screen number 4 in this case. So I'm going to get into the tabs check, and then we'll come back to our reminder here. So we should be having that up there. Let me just minimize this for now. And let's see how I can get started on the tabs. So now that we're over here, just going to make sure that we're covering this. But yeah, this is one that we have flashed a few times that came out a few weeks back. But notice, right, this is the key point. This is just kind of the review reminder that the first half of September is, if that adds to this, right, likelihood that the back half is pretty bad. And as of right now, the back half of September, this final week, has been overall pretty rough. There was the expected shenanigans that went on, but they were somewhat understandable, even if the blatant look of them was kind of hard to take. But I guess we'll get into that as part of our discussion. But just a reminder, so we were expecting things to be rough, and they were. We did have another note on that from a different contributor. So that certainly was the weak stuff that we just got through the past few weeks. This is the reminder that, right, all is really not well. And that's typically the case when you compare what Fin media has to say. They tend to focus on everything that they can to sort of make folks believe that all is well. But usually folks that are paying attention have a good sense that maybe it's not all well. And this is certainly a reminder of that, yeah, sure, there were some incredible runs in many stocks, but as of right now, you're just not there. I think the composite stock, I think essentially, if you just take a look at the S&P 500 without a few AI stocks in it, right, you're looking at something that's pretty beaten down. Not really anything compared to what the gains were, that we were registering, that were being bandied about. We're really most stocks were nowhere near that, put it that way. U.S. Conference Board leading indicators, just a little taste of what's been going on lately. You could see that a lot of the concerns we continue to voice are still there. That's why you'll see on the slide where I say, I'm really not buying what bulls are selling. I find it very hard to buy the bullish narrative that's just almost always there. Because I just don't have. I have a major problem with rates just continuing to move higher, generally speaking, and remain higher, generally speaking, and what that's going to do to the economy. I've had that take for now about 1.75 years. So I'm still concerned, and I don't think it bodes well for things, which I think we'll see. Here's just another view of things, right? That things are not really so wonderful at the moment. So you have to go back to May to find something a little bit lower than where we are now in terms of the trucking spot rates. Here's personal consumption. Unexpectedly collapses in latest GDP revision. Another kind of, I guess, reveal, right, in the sense that we've been saying that a lot of this stuff is bogus. You can't trade it that way in real time, but a lot of times later on, they are forced to admit that it was bogus. And this has been going on. This isn't about the current administration. It's basically every administration that I can remember in all my years of experience. And this is unfortunate, but that's the way it's become in the country, where you can't even trust the reports that everyone's buying stocks on as they hit in real time, at least the first time. A lot of stuff's backed out, and it doesn't look nearly as rosy later on, but no one pays attention to it. So that's the way the game works. Anyway, here's the housing market. Just one quick one on that. That continues to soften. My argument's been this is really, it's about 2/3, roughly speaking, just like the consumer themselves. So much of this economy and the modern U.S. economy is sustained and driven by the housing market, and the housing market is really in trouble compared to where it was. And one reason for that is that rates are their highest level in nearly a quarter century, and also the consumer is already struggling. So here's your credit card delinquency rate, okay, by age, but you can see that it's really the shift of the trend, right? How that's starting to move up over the last couple of years. And then you can see that this is what's becoming delinquent. And overall, you can see that bankruptcies are picking up, credit cards are becoming delinquent. Even mortgages are starting to rise a little bit. Auto loans are becoming more delinquent. So that's the trend of things right now. And again, just another reason why I have a hard time buying what they're selling. But this one is what I hoped we had after this one here. I thought I had left that there, but I guess I didn't. I wanted to cover this in relation to the fact that, things have slowed. But if you can see that the spike is incredible, right? In terms of the cost to buy a home versus rent. And you could it's very clear on this graphic here. So that's one reason, I guess, why, the housing market, which is very important to the economy, is not rolling along as it had been, right? So just obviously keep that in mind. Pending home sales, on the same note, puked in August to the lowest on record. So that's a massive plunge. That I don't know what they're referring to specifically on this graphic. I don't have it memorized, but it's just further signs of things slowing down. Now, there could be a strong bounce back, right? Just the way things close, I guess, in housing. You could have a strong bounce back when the next month is published. But as of right now, that was a rough one there in August. Here's the 2-year yield. This made a new recent high here. You can see if we bring in more data, you've got to go back a ways to find anything higher, and you really can't. So it's still near the highest levels, though it has backed off. We could say the same thing really for, I believe, the 5-year and the 10-year as well. And you could see that we're just off of the highs now. Today, a little bit of a pullback after a strong run that we've seen the last couple of weeks. So yields are just continuing to move higher. We'll just be thorough with the 10-year here. And then you'll have a look at that. So that is rough stuff, right? That these things just continue to go higher for longer. Again, this has been my whole concern since really, I would say, the spring into the spring, really, where we were getting this argument that rates will certainly soon be coming down, and instead they've gone up and stayed up. And the interesting thing, though, is that a lot of people, I think I'm part of this group too. I feel as though it might be time just to chill a little bit if I'm the Fed at this point, given all the deterioration I've seen economically. And the probabilities have started to reflect that maybe that's becoming a more popular way to think about things, or more likely in this case in terms of probability. 1 month ago, the expectation was only 50%-ish that we stay where we currently are, with nearly a 40% chance that we go up a little more. But you can see that that has shifted by about 10%. So this is now, right, this is a little bit lower than it was, these two, and this is a little bit higher that we sit still. And that's out in December. And the sit still probability has really jumped from where to hold where we are now over the last month. It was at 52. It's now nearly 86, as you can see. So that's starting to, I think, maybe head in the right direction now that rates are up as high as they are. Last week, I talked about, let me see if I can bring up these slides here. So last week, I think I mentioned that the market was oversold, but it wasn't entirely bombed out, which made it tricky. And so this is one thing that I think can help, though, because you can see now that with this week's AAII sentiment survey, you can see that the bearishness has really picked up. The bullishness has really dropped. And so if you look at it, right, this is the highest pessimism since mid-May. So that's what leads me to my conclusion this week. My conclusion really is that I think we're at a very interesting, but also a very tricky juncture. And it's just a key juncture. And it's really hard, again, to argue very vociferously, because not only is sentiment, remember, this is contrarian, so sentiment is really smoked. We have to say that, right? You're about as smoked as you've been in about 5 to 6 months, 5.5 months. So that's pretty rough stuff. And if you also look at, right, how bad it's become, here's just a different look from a different Twitter account, Bespoke, and this is their take on extreme oversoldness, right? And this is really in these various indices, right? So different indices, and then I believe this other one over here. Well, do they have? Is that more coverage on it? Yeah, no, I guess it's the. Is there a date change on there? Yeah, it's just a date change. So the 27th. So it just stayed that way, right? Really until that's where things were left. And that, I think that's why I'm saying there was some legitimate reason for there to be a rally. I think the blatant way that the rally unfolded there on really, I guess it was Thursday, or I should say late Wednesday, really was a little ridiculous, but that's the modern world anyway. But that's where things were. Sentiment's horrible. This is another view where there were just super oversold conditions, right? You had these compound oversold conditions, a lot of different ways of looking at things. We're saying you are very oversold. You are very stretched to the downside. So that's really the way this market is finishing out. Having a rough Friday session with only an hour to go, it's still not anywhere out near being out of the woods. There's another view of the bearish sentiment right there. So it's really, really spiked, really high, and right, it's pretty much the highest we've seen now since earlier in 2022. So just keep that in mind. They're saying it's almost as big as the March 2020 spike when stocks crashed, but not quite there yet. Here was another 97th percentile piece that we came across earlier this week, where that's how rough it was in terms of the breadth of the S&P 500, 97 percentile reading. So the percent of stocks with RSI below 30 was really up there relative to normal times, certainly. Not as high as we've ever seen, naturally, because there were some worse periods, but we hadn't had this in a while, right? Several months. So I think that's one reason why I'm saying that you're not entirely bombed out, but you are pretty bombed out. Let's shift it a little bit from last week to say we went from oversold but not bombed out to now I would say you're not entirely bombed out. And if you look at things like this, with here's the view of the percentage of stocks above the 20, and that did get pretty low. Now we have seen lower lows clearly, so I can't rule out that you don't continue to go lower, and I'll show that on the charts. Remember, we're kind of doing this quick and dirty. I've got some family related things happening this weekend, and I don't want to have a problem with squeezing the videos in. But here's percent of stocks above the 50. You can see that got pretty darn low. And then we usually check them all. So we'll do the 200 as well, percent of stocks above 200 day. That has more room to correct, right? So I think overall, you can see that it's pretty oversold, but can it get worse? Did you get into extreme fear? And, the answer is, yeah, you did. You got down to here, which is right intraday. You were at 24. You were, I think, a little bit lower than intraday, but you at least got into that extreme fear reading. And so again, can go lower, but look at it. In fact, look at it 1 year ago, right? Again, September, just rough stuff overall. And then this one here is the final thing before we get into the charting. What I wanted to note, though, is this is why I think part of the reason, at least why this is hard now. And if you look at, these are all the pre-election years in black here, right? And so here's the pre-election after the midterm, okay? And so we had a little bit of a midterm bear, and now you can see that really this year has been tracing out really well. This green line is the pre-election year after the midterm bear that we've been tracking. And you can see that virtually all these views, of however you want to break this data down, you get a rough finish in September. But notice that the green line, the one we're tracking for as of now, and really have been for most of this year, that has a very strong start to October before kind of hitting a wall and going back into some rough stuff really through mid-Nov before finally finding the bid to get everyone their bonuses. So again, we're not really going to say we're adhering to this. We're not just abandoning our critical thinking and observational processes, but we are noting this because it continues to be pretty worthwhile in terms of noting it, right? It really has been a year where the price action has traced out fairly closely to this overall. So given where we are with the oversoldness right now, you can't really say, well, no, there's no chance that we rally here. You have to admit that despite rates being higher, all these concerns, things do not have to go where we think they should go, maybe in a straight line immediately. It just doesn't happen that way. And so the market takes time to process things, but this is right in our newsletter this week. So I wanted to end on that because that's really part of the reason why you have to, again, it's a tricky juncture that you got to be ready to roll with. So let's switch over to the charts. Stop sharing there. Let's get the charts up, and that should be screen number 3. And I'll go through some of our bullet points, but just to quickly review, last week's bottom line was that we were not entirely bombed out. Made the market tricky. We still have to keep our eyes on the 10-year TNX and the dollar DXY US dollar, and they both were overbought, but they both found a way to continue to move up overall. The dollar pulled back a little bit more over the last couple of sessions, but they're still sticking higher. I think, having looked at it, that it's pretty regular that when the TNX does have a spike like this, it usually does have a phase where it pulls back not too far thereafter. So I don't think, given the kind of move that TNX has made, the 10-year yield has made, I don't think that it would be crazy to think that maybe this starts trading back towards the 20 SMA there in light blue, something like that. And that would probably help it fill this gap as well. So I wouldn't rule out, I don't know what's going to happen, obviously, right? And this is certainly not my market. I don't spend my days in the bond markets seeing what's going on there. I'm just making the observation that technically that does seem to happen a lot, where after you've had a big move, you do retreat. And even within, that's really the way this uptrend is really unfolded. So after this kind of a strong move, I wouldn't be surprised if there's a little more pullback. That could help the bulls hold where we are in the market and then lift from there. Okay, so we did note that we thought there'd be a bounce attempt this week, and there was. We said we remain more of a seller for now if rates and the dollar continued to move up. and we said they may need to chill. So they did continue to move up. There was a rally attempt. That rally did get sold into here really on Friday. They finished it this morning, and they've been selling into it ever since. So overall, that was the take last week. The outcome really was we're here where we are right now in the markets, right? The outcome was, yeah, a lot of the things we covered last week ended up being worth mentioning. They were relevant. So at least we're relevant. But again, the exact path of what happens is very hard to predict in advance, right? The exact path, not an easy thing to do. But here's the SPY. And what I'm going to show here is that I made this line that was orange, light blue that I'm mousing over because I wanted everyone to have a better view of it. And that's a support line that I've had that I extended and I adjusted the color on so we could see it better. And right, you now have a situation where the SPY is below the short-term moving averages all the way from the 10 through the 50, which is white, all the way through gold. Got the 15, the 20, then the 50 up there in gold. And they're downsloping. All of those are now downsloping. The longer terms, right, the 100, the 150, the 200. In fact, the 150 loomed large. And I do think we mentioned that. The 150 in the SPY is where we got to. And now, right, I've been saying that if it gets there and it can't hold, my next area has to be your 200-day down here in purple. I think somewhere near this 416, 17 level, that's where there's another fib as well. That was asked of me in the Rebel Pit Elite this week. And I think those are your next really key levels if we continue to fall. Right, you could see that the 150 was something that they tried to respect here, though, this week, that rust-colored SMA there. But you're now below the support line. For now, the support line, right, that I'm making blue, now lighter blue, that support line held in the form of resistance because we're now below it, right? And so that goes back, and you could see that it goes all the way back to the October lows. And you could say, well, it's just a line. You just put it there. I just connected a couple of lows. All that's true. But unfortunately, a lot of times these lines end up mattering. And why exactly they do, I do not know. Self-fulfilling prophecy is the answer a lot of people would give. But you don't want to see the market try to bounce from pretty oversold conditions, nearly bombed out conditions, really, and get pretty toasty on the downside, right, where there was a lot of smoke from all the selling that was happening, and then it runs into trouble, and right away, right, they start distributing all over again at the end of a quarter. This is the last day of a quarter. And remember, this 432 level, which is where it fell shy of by just a little bit, I believe today, maybe like 15 cents in the SPY. Not that we care about that kind of 15 cents. But the general idea is we said 432 was a big level in our minds, really a very long time ago. And it was for a while. And it kind of mattered here. They held it. They stayed below it. They brought it above. They kind of came back and tested near that 432, 430, came back to it again and held. This time it didn't hold, plunged through it, brought it back up right almost to it, almost dead on, and then they started selling it. So that is not a good look, right? You would have to say, well, that's really not a good finish to a quarter. You really can't get excited about that. I think that the charts could have been worse, right? Because the way that the charts could have been worse is if they really smoked this thing without that kind of bogus sort of orchestrated rally they put on late on, I should say not late, but on Wednesday afternoon, after a lot of damage had been done early in the week. That was very blatant to me, even though, like I said, I think there was a good reason to really rally at least somewhat, right? It was really the form it took on that really frustrated me, because it was just so obvious. Just, hey, this is our market, you're just trading in it, right? That kind of a thing. But that's reality anyway. Maybe I just don't like being reminded of it. But the greater point right now, though, is like, this is not ending well. Now, the best thing you could say as a bull right now, I think, is, hey, man, we didn't have to go to the 200 day, but that could still be in your future. Hey, we held the 150 for now. You did. Hey, we're pretty bombed out, right? I think that's the best thing you can say, that we're pretty wrecked here, and not entirely the worst we've seen, because we went through all that material in the tabs, but it has been worse. We know that, but it's pretty bad now. However, I think we're nearing that cascade phase where if you look at something like this, you're only a little, and I'll pull this over here, you're only a little way away. You can see most of these sectors, which I'll cover in a very brief sector situation video, most of these sectors have had it rough. The ones that have held out were the independent XLE, right? And then the XLK and XLC, which I continue to talk about. Most of the rest of the sectors have been really struggling and falling apart. If not really struggling, they were falling apart. And so to me, this is clinging right now very interestingly in terms of what's happening in communications and Excel, and also in tech. And so SMH, they held. It's very obvious to me, though, that those are not out of the woods, and I'll cover, probably that'll be the main thing I cover really in sector situation. But I think you have to continue to look at the dollar. You've got to continue to look at TNX. As I say, nearly all sectors went risk off. Had a wild finish and a rough, apparently, finish to the quarter. Not a good look, right? So I think if you continue to, if the dollar and the yields continue to defy gravity and the overboughtness that they're in right now, that could really put bigger pressure, and you could see that final capitulatory selling. I'm sticking with these targets for now. I do think sort of right near the 200 at 418.93 in the SPY and 417-ish. That's where I'd expect there to be a confluence of support. And it doesn't mean you can't go, a point below there. In fact, if you do go a point below there, I think if I highlight this level right here, you could see like right at 416, actually, there's very close to 416 even. There's a flat line, I think, that I would draw in there. I don't know if Ryan has one there, but I would put a flat line right near 416 just from the price action, hesitating there or very close to it so many times. But then, right, the next level, big level, I mean, there's certainly other fibs we can hit on the way down. The 38.2 fib puts you right near 417, right? So that's one reason, and you're right near the 200 at the same time. So I think those are big, obvious areas where a lot of folks would expect there to be some support type action. And like I said, I think there's a flat line there. There's other flat lines that are clearly there, like right near 410, 411 in SPY. There's another one. There's probably a little one near, I'm going to say probably even a little higher, near 413. There's another one. So we can go through all that. Sure, and we do in the services. We talk about that nitty gritty more. But what I'm really looking at as a big picture situation for the next level really would be something like this 396.54, just because that would be a gap closure. And I think this is one of those gaps that it's easy for your eye to miss it unless you're really doing a really quick gap check. And so that to me is if all hell breaks loose, I'm thinking just a little, right, like a few points below. I wouldn't wait, right? If you are in on a trade like that and the price action unfolds that way, I'm not going to be bidding 396.50 because that closes the gap, right? I'm going to be bidding in front of that because everybody tends to want to see gaps when we get close to them. And I don't really focus on gaps really unless I think there's a possibility. And I don't think that has to happen next week either. So I'm just saying, though, that would be really more of like if the bulls are not able to hold, and I do think that they do need to step up and hold where they have to be able to create some kind of an early October rally. Otherwise, things will, could worsen even more and more and more. They're at that point. So they need to hold above this 150 for now. And if that doesn't hold and they rock this thing down here, yeah, I think the odds are you definitely trade down to 417. That doesn't hold, we'll start talking about other levels. But if it turns into this cascade kind of like washout phase that we've seen so many times, I would, and let me try to bring in a little more data on that. I would think that 390, let's call it 397, just to throw out a round number. 397-ish to me becomes a big deal. And I don't, like I said, I wouldn't bid right at 397 or something. I'd be right near 400 is probably close enough, big round number. But what I'm talking about in terms of like your cascade phase, if I can get one, would be where you really just have this. Let me see if it lets me. It won't let me grab this. What can I do? What can I do here? I've got another. I don't want to grab another browser though, and it might just slow things down. But you can, let me just try to trace over, right? Something like this where you get just that waterfall effect where there just aren't bids. And I think if you do spike on yields again and the dollar's doing its thing, I think there's going to have to be that recognition by some that we may have gotten into soon, and maybe this economy isn't as on as good a footing as we had sort of bought into. And another reason, right, that I wanted to mention, here's my little counter that people tend to ask me about. Just a simple control, like in other words, who's in control of the market counter. And if you see it there, it says -9 right above that candle. That tells me that the bears were in control for 9 sessions. So you, me, and Edna, everyone knows that the bears normally aren't in control for anywhere near that long in the modern stock market. So, that is getting a little aged, and that's one thing I keep my eyes on. So that's why to me, like, I really can't say that I was surprised that they stepped in when they did, because I think there were a lot of reasons why. Like it did sort of make sense. Bogus as it was, it made sense. So I hope that makes sense in terms of conveying what I'm trying to share. So the issue now is early October brings relief rallies. I still am not buying what these guys are selling. I still hope to be wrong, but that does create a wall of worry. We've seen them mark up the NASDAQ for over 50% in the form of the QQQ, right, from October through the highs of this year. So we know, and that was with rising interest rates, right? So we know that what they're capable of, and we can't lose sight of that, because as much as I'm really an economic bear still, wishing not I weren't, I have to be, though, with rates and the dollar being the problems that they are at the moment. And I think you could just see the deterioration, right, in so many things. If you look for it and you're willing to be open-minded and not just perma bull all the time, you can see that there's legit problems, I think, out there. So there's a lot of risk right now, but look at this rally that they put together. So they're capable of doing these things, but much stronger than any kind of little push that we could see in the first couple of weeks in October under normal circumstances. So I certainly would not rule that out, that you could get that from here. And this stuff is clinging. These cues are clinging better than the spiders. And I think that's really due to the SMH, right? I think that the SMH, the XLK, like some of the XLK is a lot like the Qs, but they're able to sort of keep this AI thing going. Everyone, including Aunt Edna, knows there's a gap there that should fill. We've talked about it many times. I think it will eventually, but a lot of people are maybe trying to force that. And that's one reason why, right, these fresh shorts are making it tough on people that have been on this for a while to get that final payoff. But I think the odds are it's still coming at some point. Whether or not we get it sooner rather than later, I don't know. But again, I think in the final risk off where we do get the cascade selling in the market, you would then get down to the 200 there in purple. That puts you really within striking distance. So it all makes sense. Could you see a rally back to the 50 in something like the SMH, right? Where, again, Friday closes, Monday, they have no memory, which has become a very common thing. Oh, it doesn't matter. The quarter ended poorly. I'm going to just find a way to lift stocks back up here on Monday for whatever reason in the face of even rising rates. But it wouldn't surprise me to see this thing pop a little more, just as it wouldn't surprise me to have this thing go down. But it's not in a situation right now that's clear. We're not near a low. We're on the way back from the low. We do admit that down here, right, the market itself was due probably for some kind of a relief rally attempt. We're getting that right now. It hasn't fallen apart yet. So to sit here and pound the table, again, it doesn't make any sense. I think you've got to say, let's see what yields are doing. And if yields are screaming, I'd be a big skeptic. I'd be a skeptic in terms of this thing just continuing to power. If yields are up small, neutral, or coming down even better, then yeah, I think the chances that you potentially close a gap like this or something on a continuance of the relief rally as per the October price action trace out in the third year of the presidential election cycle, I could buy into that, right? I could buy into that. But, and especially because I do think the markets are oversold and nearly bombed out, not entirely bombed out. We're not talking about, you know, some awful carpet bombing bombed out, but it's pretty bombed out right now. So you got to factor all that in. That's my big kind of look. I think the only two sectors left standing are XL in a really great technical way out of the 12 that we typically cover are XLK and then XLC. Those two have not really rolled over visually, right, and to the degree that other ones have. So that's where a lot of these big investments are concentrated. If we put the package together of AAPL plus Amazon plus we'll do Google plus Meta plus MSFT, right? That should give us, and we could throw Tesla in for good measure. I guess I'll throw Tesla in there. And we throw these together, like these big six, you could argue, these have hung in there, right? Overall, they are, what I was saying earlier, or I think it was earlier this week, that these are near a key low. And that's because that we were just above this area here on Wednesday before they turned the tide, right? The way that they did. That's why I was saying that in some of the webinars and in Rebel Pit Elite, because that was, you know, that was clear, very clear that this level had to hold. Otherwise, you're on your way again down to the 150 SMA on that package. So that package to me is still barely hanging in there. And so, and the way that I look at it, you know, most things are already over roasted to the downside, and the big stuff's hanging in there. And if that doesn't crack, right, given how big those weights are, and technically it doesn't look as bad at this moment as other things do, then that makes it easier for that October rally to unfold. So I think you are very close to where these bulls have got to hold this week's low. If they don't hold this week's low, then that whole scenario we talked about is back on, where probably this package visits the 150 there in Rust. And then the SPY and the Qs, they visit the 200. They're on their way really towards the 200 and some of those other key levels that we talked about in SPY. That's where I'm at, right? If they don't hold those. And I think I'd start feeling better about this market if it could get back within above that trend, right? And that line that I'm going to now make lighter blue, that one is the trend line. So if it gets back above there at 432-ish, I would start feeling better if it could hold above there in SPY. I start to see some breadth improve, things start to, overall, the bid comes back, and that tendency that we have in the where is that? The tendency that we have in, that is not it. That's a different, okay. Bear with me for 1 second here. I don't want Rebel Pit Pro. I want Rebel Pit. No, I want Rebel. Is it Rebel Pit Pro? Yeah, that is what I want. I'm thinking I don't want that, but I really do want that because that's the newsletter that I brought up. And that's it. Just early oct, right? After a rough SEP, you typically get this at least 1 week of decent upside. So it wouldn't be a shocker, right, if we came in on Monday and it was all forgotten about, right? Just remember that. So that's why if you take all these things into consideration, this is why this is a tough juncture. Do I think that this thing should really get routed further? If I'm a bull, would I be happy if it did get routed further right now? I would, because that would set me up to get rid of all that selling, clear out the market. And then, right, anything that's not horrible or mildly bullish can help me create this end of year rally that I so desperately crave, right? But that's, not really how the bulls always operate. So I think they need to hold here. Otherwise, they're putting themselves at bigger risk. And then if these kind of like that 416 area does not hold and you're seeing rates scream, dollars hanging in there or screaming, then I think you're going to get that final capitulatory boom down to somewhere just sub 400 would be my best guess at the moment, frankly. So I think that's going to be a wrap on the big picture stuff. I think you have to remain at DEFCON 1, which means you're ready to play defense, or you are actually being offensive in terms of playing defense, as long as this thing cannot get back above trend. If it gets back above trend there, let's call it 432 just to keep a number on there. It's tentative, right? The first day it does it. But if you start seeing it being able to do that, it will look better. And then after that, if you have this right here, I'm trying to set things up over here for cleaner views here on Trading View, which is why I've got this way. But I'm thinking, right, using Trading View, that they'll come back. You can see the gap there on SPY. If this thing really plays well into the first half of Oct, I would think they try to get it up near, let's put a good number on there, a nice round number. I would say 443, right? That would be just about it. About 443 would just to put a round number on it. Something like that, if they can extend the rally that we should have according to the third year of the cycle coming up now. So if it's a 1 week rally, that's probably bad. Clearly a 2 week rally is better because it does take us further away from the danger zone, if you're a bull, that is. So that would be my way of looking at it for now. I see a lot of risk out there that the bulls have got to address now or never. We had a little graphic we shared this week of, I think it was Felix the cat whistling past the graveyard, and then we presented the old cartoon move with or do we get the cavalry? And we got the cavalry, and that was really just in front of when the cavalry showed up, because we knew really just from experience that things were really on the ropes and about all hell was about to break loose if something didn't happen. And lo and behold, the cavalry showed up, and it was blatant. If you go look at the intraday action, it was remarkable, right? How suddenly, and I won't get that's the problem on here though. I won't get a good, I'm not going to get a good like visual on that here. That was really the 27th, but yeah, it was right here. And it was just, you had to kind of see it on the 1 minutes to really fully appreciate it at the time. Out of nowhere, they just couldn't get enough stock for about 30 minutes, just almost like relentlessly, maybe even a little longer, relentlessly buying and chasing stocks where they could have bought as much as they wanted earlier that day, just kept bidding for it. But somehow they decided they needed to start chasing it. But hey, we've seen that so many times. So on that note, I think I'm going to wrap up. Hope that you got something out of this week's video, and I hope it can help you in the upcoming week or the weeks ahead. And I do want to thank everyone for tuning in and understanding that with these family events coming up here, that I had to sneak this in, and now I've got to go check UOA to see if there are any updates I've got to get out. So thanks again, and have yourselves a great weekend and a great trading week coming up.